Let's start simple. The S&P 500 is basically a list of the 500 largest publicly traded companies in the United States. The S&P stand for Standard & Poor's, which is the company that created this list, and the 500 is the number of companies it includes. Think of it as a snapshot of how the American stock market, and by extension, the American economy, is doing overall. When people say the market went up or the market went down, they're usually talking about this index. These 500 companies include some of the biggest names Apple, Microsoft, Amazon, Google, and many others. But it also includes companies from many sectors like healthcare, energy, finance, and manufacturing. Together, they represent roughly 80% of the total value of the entire U.S. stock market. That's why the S&P 500 is considered one of the best indicators of the market's health. Now, how does it actually work? Each company in the S&P 500 has a certain weight based on its market value, which is just the company's stock price multiplied by the number of shares it has. So, larger companies like Apple or Microsoft have a much bigger influence on the index than smaller ones. When the stock prices of these companies rise, the S&P 500 goes up. When they fall, the S&P 500 goes down. But it's important to remember that it's an average. Not all 500 companies move in the same direction every day, but some might go up while others go down some. But the index shows the overall movement of the market. The idea is simple. If the S&P 500 is growing over time, that usually means the biggest U.S. companies and the economy behind them are doing well. If it's falling for a long period, that's often a sign of trouble or uncertainty in the economy. Let's look at an example to make it clearer. Imagine you invested in an S&P 500 index fund 10 years ago. That means you didn't buy a single company's stock. You bought a tiny piece of all 500 companies at once. Over the last decade, despite ups and downs, the S&P 500 has roughly doubled in value. That means your money would have grown about 100% without you having to pick individual winners or time the market. That's the power of diversification, spreading your investment across many companies instead of betting on one. And that's exactly what the S&P 500 allows you to do. If you're new to investing, understanding the S&P 500 can be a great starting point. You don't need to memorize all the companies or track every stock. Simply following how the S&P 500 performs can give you a sense of the market's overall direction and how the economy is feeling. And if you ever decide to invest, low-cost S&P 500 index funds are one of the simplest and most effective ways to begin building wealth long-term. If this helped you understand the S&P 500 a little better, consider subscribing to Simple Revenues. Every week we explain complex financial ideas in just a few minutes, clearly, calmly, and without complexity. Thanks for watching Simple Revenues, Finance Made Simple.